Hey, if you're a strip mall developer and you need a set of financial projections to present to potential investors and lenders to raise the capital you need to get your project off the ground, then you've come to the right place because we have developed a financial projection template built specifically for new strip mall developments. And I'm going to walk you through how to use a template, how to fill it out, how to use it to attract capital. And so before I really dive into the details of the model, I'm going to just do a high level, quick overview of what you get in the model so that you don't have to watch the whole thing to just understand what's going to be involved here. But before I do that, just a little bit of background. My name is Adam Hoeksema. I'm the co-founder of Projection Hub, and over the last decade, we've helped over 50,000 entrepreneurs create financial projections for all sorts of different businesses. Today, we're specifically focused on our strip mall developer projection template, and I'm going to walk through that for you now. There is a link to the template in the description of the video below, so you can go grab that there. And if you stick around to the end of the video, I will, as a reward or a thank you for doing that, I will tell you how to get access to a coupon code that you can use to get a discount on this template. So with that, let's go ahead and look kind of at a high level overview of what's included in the model. Okay, so we are on our at a glance tab here, and this is kind of at the end of the process. You'll have a number of charts and tables and graphs that you'll be able to produce that you can present to investors and lenders, and construction budget, different key ratios and KPIs that you'll need. We also have a 10-year, so this is a 10-year model, so a 10-year cash flow summary, a balance sheet summary here, 10-year balance sheet summary, 10-year income statement summary. And then we actually have the cash flow, balance sheet, and income statement all broken down by individual months. So if you need that monthly level detail as well, we have that included for all 10 years. Now, that's kind of the report out section of the model. There are a number of input tabs that I'll run through here quickly now. So we have input revenue tab, and what we're going to do here is put in our different unit types. So we're going to keep it pretty simple, and we would just say, hey, we have kind of our strip mall middle units that are priced one way, and then the end cap units are priced a different way. And so you can see how you can enter in those assumptions. You can enter in vacancy rate. This will help you forecast your gross potential income and effective gross income. And then we'll need to enter in our operating expenses here, so you can see how we can enter in specific operating expenses. Here we can enter in expenses as a percentage of revenue. Here we can enter expenses as on a per unit, a per square foot, or per property basis. And we can also enter in salaries and wages as well. And so the goal at this point is to be able to forecast our net operating income in order to kind of understand how much loan capital we might be able to qualify for. We need to forecast our net operating income first. So that's what inputting the revenue and operating expenses will allow you to do. And then we can, on the financing tab, you'll see assumptions about, hey, what's our debt service coverage ratio that your lender's probably going to tell you they want to see. You can enter in expected interest rates and terms. And then based on those assumptions and your net operating income, the model is going to help predict, hey, here's how much debt, here's how much of a loan we think the strip mall could support. And so from there, you can then add in equity assumptions. So how much equity are you going to invest in the project? And we'll get into more detail in this shortly. But this is kind of the goal of the model, is to help you figure out, okay, based on what I'm planning and what I think I can operate as, how much net operating income can I generate? From there, how much debt and equity do I think I can raise? And that will ultimately set my construction budget, right? So that's the last input tab here. We can say, okay, now we know how much we have to work with here, and we'll enter in our construction budget assumptions here. Then finally, once you're kind of all done with all of that, there's an investor distribution tab here where you can look at your cash flows for the 10 years, and then you can set some assumptions here about, hey, how much of our cash do we want to distribute to investors throughout the 10-year model? And then let's say we sell the property. So we're going to sell it after year 10 at a 6 cap. That's going to give us, X amount in net sale proceeds after we pay off the debt. And this will be distributed to investors. And then based on all of those assumptions here, finally, we can see, okay, here's the IRR that an investor would earn based on all of these assumptions. So we're sitting at a 17.82% IRR. You can see some other key investor return metrics here as well. Okay, so that is kind of the overarching view of what we're doing here. Now, this is a pretty complicated and complex model, and you might be thinking, boy, I just need something really simple. This is overkill for me. And so we do have what we call our simple strip mall model as well. That is, much more high level. It's not going to help you model out like investor returns. It's not going to help you model out really how much debt you can afford and those sorts of things. So it is limited in that way. I think if you are really trying to raise capital from sophisticated lenders and investors in the space, you're probably going to want this developer template. But if you're saying, I just want something easy and high level, there's a link in the description of the video below to our simple strip mall template as well. Okay, so with that, I'm going to go back now and dive in a little bit in more detail about how these different tabs work and how to input information. Before I do that, just wanted to mention, if you have any questions at this point, you can reach out to us at support@projectionhub.com, and we'd be happy to try to answer any questions you might have or walk you through this process. Or if you need help filling the model out or customizing it for your situation, we can help with that as well. Okay, so let's go ahead and go back to our input revenue tab. So here you can enter in the different unit types, right? And so we're going to say, hey, we have 2 end units and 8 middle units, all of which are 1,200 square feet. Here's the annual rent rate per square foot. And then the model is going to then estimate your monthly rent. Okay, so here you can say what your completion month is. So if you think, okay, in the model, we're saying the project's going to start, or the projections are going to start on January 1st, 2024 here. And we think these end units will be completed, construction will be completed on month 17, and the middle units on month 18. And then we'll be able to rent these out almost immediately the next month. So month 18 and 19 will be the first rental month. And then here you can add in assumptions about how many months is it going to take to rent out all of these units. So as a default, I said 2 months for the end units because they're probably going to be most popular, and 6 months to rent out all the middle units. Now you can also enter in additional revenue per unit. Now if you're charging for parking, perhaps, that's probably unlikely in this type of scenario. Maybe storage, you have some storage space, or just miscellaneous like common area maintenance fees. You could add those in here as well. Now, we can also add in an annual rent increase. So we're assuming a 5% annual rent increase. We are also able to input our vacancy rates here. And so we're starting out saying, hey, we're going to have a 20% vacancy rate to start out with, but that's going to drop down to 10% over time. Now, this also includes bad debt and free rent. So let's say in order to attract a new tenant, you need to give them, 3 months of free rent. Well, that's kind of like having that space vacant for that period of time. The customer's not paying, the tenant's not paying rent during that time. So this is kind of the catch-all. This is the vacant units. This is the units that are not paying rent because you're offering free rent for a period of time. And this is the customers that are just not paying their monthly bill. So that's what you'll want to include here. Now, on the percentages down here, this relates to those additional revenue items up above. So we're saying, hey, what percentage of our tenants are going to pay these additional fees? So we're saying 100% of our tenants are going to pay that $100 a month. If you offered storage space, for example, and you thought, well, maybe only 30% of our tenants are actually going to pay or utilize a storage space. So you could enter in a percentage here like that. So that all will allow us to calculate our gross potential income as well as our vacancy and credit loss, and ultimately our effective gross income here. To get into a bit more detail on the operating expenses, I'm going to point out a couple things. So you might have some expenses that are one-time expenses. And a good example would be our grand opening marketing expense. So we're saying on month 15, we are going to spend $5,000. But this is just a one-time expense. So we say the first month of payment is month 15. The last month of payment is month 15 as well. And then it asks, hey, is this going to repeat each year? And we're going to say no. And say it's not going to repeat because it's just a one-time thing. Now, here we can say, as an example of an expense that is in a specific month each year, but it does repeat. So your real estate or property taxes. So we're saying our first month of paying property tax is month 19, and it's going to be $1,000 per unit. So you can see how you can add either per unit, per square foot, or per property assumptions. And then we think this is going to repeat in the same month every single year, right? We're going to have to pay that property tax at the same time each year. So that's how you would enter that in. Now, you can also enter in expenses like a software tool that you might use to manage part of the business. So this could be something that is billed, for the entire property. It's not a per square foot or per unit cost. Other expenses like maintenance might be easier to model out on a per square foot basis. And you might have expectations on what your maintenance cost would be on a per square foot basis here. Okay, so actually let me just mention one more thing down here. So the percentage of revenue expenses here. So let's assume we are using a outside firm, a management firm to operate and manage the property. A lot of times they will charge a percentage of revenue as their management fee. So I've got a 5% management fee built in here and a 1% kind of general and admin fee. That could be the same property management company that's also charging that, or maybe that's your in-house accountant handling that, and that kind of scales with the revenue of the business. Okay, and then last thing on this page is you can set aside a reserve for replacement. So we're going to say, hey, yeah, let's put some money away each year as a reserve for replacing HVAC units or the roof, the parking lot, those sorts of things. So this is where you can assume kind of some reserve for replacement assumptions each year. All right, so we also have the ability, let's say you are not going to hire a property management firm to manage a property, but you're actually going to hire employees. Right now, I have this set in here to 0. So where it says number of this particular employee is 0, because I don't want to double count. I've already assumed that we're hiring this operations manager here for a percentage of revenue, so I don't need to double count. But if you are going to hire an employee, then you'd want to put 1 in here instead, and you could put their annual salary, annual benefits, what month they start and end as well. All right, so getting to the fun part here on the financing. So this is a bit of a puzzle. So as you're entering in your own assumptions, you're going to ultimately forecast your monthly net operating income once the property is stabilized. So this will be calculated based on the revenue and expenses that you've entered in. It's going to say, okay, you're forecasted to generate $15,627 a month in net operating income. And you said, or the bank said, you need to have a 1.25 debt service coverage ratio. That means that you can afford a monthly loan payment of $12,502. Now, let's say the bank said, no, we really want a 1.3. Okay, well, now you can only afford a $12,021 monthly loan payment. So you can see how those assumptions will change how much you can borrow. And then based on your expected interest rate and the term of the loan, along with that monthly payment, we kind of back into, hey, how much can we borrow? And so we're saying, based on all these assumptions, we think we can borrow $2.1 million. And we're going to be conservative, and so we're going to have a 2-to-1 debt to equity ratio, and we're going to invest $1 million into our project here. So we'll have $1 million in equity and roughly $2 million in debt. So that's what this is saying. Our maximum debt plus equity financing is $3.2 million. Well, we went ahead and said, okay, what are we actually going to enter in? Down here is where you actually enter in the equity sources. And so we're saying maybe we already owned some of the land, and so that was our initial kind of existing investment, $100,000. And then we raised some outside funding and raised $900,000 in equity that was invested in month 4. And then for the loans, we're going to come back to the financing costs here in a second, because we need to come down here first and say, okay, here's the construction debt. This is where we enter in the amount of the loan that we're actually planning to take out. So we're saying we're actually going to borrow our $2 million loan here. And this is the construction loan, right? And so we're saying it's a 7.5% interest rate. We are going to make interest payments on this, and the first interest payment will be due in month 7. And so if we come back up here on the financing costs, we expect that there'll be loan closing costs and financing costs, bank fees, inspections, appraisals, all sorts of those types of fees that come along with each kind of phase of financing. So with the construction debt, we've assumed here a 1% fee, 1% of the loan as a financing fee. But then you also notice we've got mini perm debt and permanent debt here. And so what we're assuming is that eventually, once the construction is complete, we are going to refinance out this construction loan. So that's pretty typical. You don't typically keep the construction debt and just pay down on that forever. You refinance that once construction is complete. And so a lot of times you will go into mini permanent debt. And so we're saying we're going to refinance in month 30. And so you can say, all right, we're going to refinance that $2 million construction loan that's right here with a new $2 million loan that's mini permanent, and it's going to be at a 6.5% rate over 360 months. And then we think in 30 more months, so in month 60, we'll actually have the project and the property, fully up to kind of its full potential at that point, and we will maybe want to refinance again with permanent debt, might be able to get an even better rate and terms. So at that point, we're going to refinance again at an even lower rate is kind of what we're assuming here. But then all along the way, each time you do that, again, you'll have these closing costs, financing costs, and so that's what you enter in up above here. Okay, so that's a lot there on the financing side. One thing I will point out is that when you're entering these assumptions, you might notice that some of these fields will turn red as a warning. What you're looking for is to make sure that they're all green. So let me just give you an example here. Let's say we needed to have a 1.5 debt service coverage ratio. Okay, so if we needed a 1.5 debt service coverage ratio now, all of a sudden we're saying, oh, the maximum debt that we're able to afford is 1.7 million, but we entered that we were going to have a $2 million loan. So that's why this turned red, because it's saying, nope, you actually can't afford that. And so you'll notice that as you go throughout the model. And again, if you have questions about that, you're struggling with that, that is something we can try to help with. But this is a puzzle. You're kind of trying to figure out what can I afford and what can I actually then afford to build, right? So let's get to the construction budget, because now that we've kind of got the financing figured out, we need to figure out, can we actually build the property that we're planning to build here with that budget? Can we come in on budget? And so, you can enter in your hard costs on either a per unit amount. So the way you could enter this in is say, we're going to kind of treat each individual unit in the strip mall as its own unit, and we're going to spend $175,000 per unit. Or if you wanted to, you could just say, put in the whole property amount. So, the whole building's going to cost $1.75 million, and you could just enter that here. So you can see an example, like for the land. For the land, we just said it's $500,000, and we didn't put in a per unit amount for the land. We just put in the total amount for the land. So it's just an example of the kind of two different approaches to how you can enter in those expenses. Furnishings, probably not going to have much in the way of furnishings, so we left that at 0. Utility installation, we said it was going to cost us $10,000 to get each unit kind of have their utilities installed. Final grade and sod, $75,000, and a parking lot, $200,000. You can estimate the timing of when those expenses on the construction budget will happen. Okay, and then there is a section down here to be able to add in fixed assets that are in the future, because this is a 10-year model. And so you might say, well, and we know we have a plan that every 60 months we are going to, do some renovations or add some new fixtures to the property, update the property, right? And so we added in a $25,000 budget and $160 for some renovations. Okay, now let's go to our input distributions tab just to see, after we've done all of this, what does this look like for our investors? You can see that this is going to model our cash flow, right? And so you can see your cash before distributions at the end of each year. And then maybe early on when cash is tight, you need to hold on to all of that cash for operations. But then at some point you might say, well, we really don't need to hold on to all of this cash. We can distribute some of it. So here I have assumed that, hey, we're gonna reserve 50% of our cash, meaning the other 50% we're going to distribute to the owners. And so we do that for the rest of the model until we sell the property in year 10 at a 6 cap. And then based on that, our net sale proceeds will be $3.3 million after paying off the outstanding debt. We know that the total equity investment in the deal was $1 million. And so this is doing all of the calculation on the investor returns. You can see the cash flows coming in, and then ultimately the IRR and the cash-on-cash returns as well. Okay, so that is the model. Again, if you have any questions, reach out to us at support@projectionhub.com. And as a thank you, as I mentioned, as a thank you for watching to the end of the video, if you go down the description of the video below, there will be a link to a form that you can fill out. And then we will email you a coupon code that you can use to get a discount on this template. And just as a thank you for watching to the end. So hope that's been helpful to you, and let us know what questions you have. Thanks.